If you watched the market over the past couple of weeks, you saw tech get hammered again. Chip stocks sank, the semiconductor index slipped into bear market territory, and an old fear came roaring back. That being AI is going to make much of the software industry obsolete. Wall Street didn't wait around to find out. Investors dumped software stocks first and asked questions later. They even gave it a name, the SaaSpocalypse. As most of you know, SaaS means software as a service, and over the past year, software companies have lost about $2 trillion in value. Even giants like Microsoft, Oracle, and Salesforce got caught up in this sell-off. But here's what really caught my eye. A handful of names quietly refused to go down with the ship. I could see signs there was something unique about them, and that's why I've been loading back up into the software space in these select names. So today, I'll show you 3 software stocks that make the grade and then answer the key question, was the whole panic one giant overreaction? Now, if this sounds like a topic you want to hear more about, then hit that like button. It tells the YouTube to put more videos like this into your feed. Let's start with a company that does something almost aggressively boring. We're talking about phone systems. We're talking about the company Ooma with a symbol of OOMA. They sell cloud-based phone systems to small, medium-sized businesses, the folks that finally are ditching those ancient desk phones for the cloud. Boring on the surface, but not so much when you look at the underlying numbers. And perhaps more telling, the stock is up roughly 20% in the past 30 days, while most other software names have struggled. Before I go on, I should probably tell you who I am. I'm Steve Reitmeister, but all my friends call me Righty. I've been investing for over 40 years, and today I'm a partner at WallStreetZen.com, where our quant rating system analyzes a wide array of data points to identify stocks with the highest likelihood of outperforming the market. Now, another quick note, this is all for educational purposes, not personalized investing advice. So always do your own homework before buying or selling any stocks. Now back to Ooma. Once a business signs up, that revenue is recurring and switching costs are high, so customers stick around for years. This helps explain why Ooma has strung together a long run of earnings beats without a single miss. But what's even more exciting is what's coming ahead. Ooma's earnings are forecast to grow by over 66% a year, while the rest of the telecom industry is forecast to grow at a meager 9% pace. Now on to our data. I'm talking about the Zen Ratings quant model that scores every stock across 115 factors and then boils it down to an intuitive letter grade of A through F. Ooma indeed earns an overall rating of A, amounting to a strong buy recommendation. Even more impressive, it ranks in the top 1% of the greater than 4,600 stocks we track, owing to a truly stellar fundamental profile. Underneath the overall ratings are 7 component grades that help identify a stock's specific areas of strength and weakness. Now, Ooma continues to impress in these areas, such as the top 19% showing for financial strength. Then we have top 9% of all stocks for sentiment, which tells you the smart money is leaning into these shares. But the true standout here is the top 1% showing for growth, which is the best possible way to foreshadow more earnings beats ahead. You might notice the modest C grade for value, but C is the biggest bucket of stocks where 60% of the stocks reside. As we pull back the curtain, the reality is that Ooma is in the top 23% of stocks for value, so not too shabby on that front after all. So here we have a software company that used AI to improve its offering, leading to very sticky recurring revenue. This shows up in spades in the Zen Ratings 115 factor review, especially the top 1% showing for growth. This is precisely why Ooma has earned a spot in my Zen Investor stock picking portfolio. This is where I feature my top 20 stocks for the long haul. Spoiler alert, the next 2 stocks in the video today are also in the Zen Investor portfolio. But first, a quick heads up. If you like discovering under the radar stocks like this, then the best thing you can do is to sign up for my next live training session this coming Monday. The focus is on timely market insights plus my top picks. It's totally free, but you do need to sign up. Do that now to join me this coming Monday at 7 p.m. Eastern Time. Just go to WallStreetZen.com/live. Let's roll on to our second impressive software stock in Taboola with a symbol of TBLA. Now, this company also got caught up in the crosshairs of the AI is going to kill software hysteria. That did originally hold down shares for quite a while, but is now up about 20% in the past month. Now, here's the background story. Taboola runs a digital advertising and content discovery platform, reaching over 600 million people every day, and no doubt you've used it many times in the past and didn't even know it. Now, when the fear hit, names like this got crushed under the idea AI was going to make them obsolete, but Taboola flipped that on its head. Their new AI-powered ad engine called Realize is actually driving advertiser growth and keeping customers longer. AI isn't killing Taboola, it's simply making Taboola more money. In fact, Taboola's earnings are forecast to grow over 25% a year, much faster than the industry average. And yet, the stock trades at a PEG ratio of just 0.55. This indicates it's a screaming bargain when the average stock trades for a PEG nearly 3 times higher. Before I get to the analyst recommendations, a quick ask. If you're getting value from this video, then please hit subscribe and turn on the notification bell. That's because I publish data-driven stock analysis like this every week, and it's the best way to ensure you don't miss any of it. Back to Taboola. There are some Wall Street analysts taking notice. This explains why they enjoy 3 strong buy and 1 buy recommendation, meaning no holds and no sell recommendations out there. Buy recommendations are kind of a dime a dozen, so what's much more important is who is standing behind that recommendation. In this case, we have an analyst in the top 7% of his peers based upon the stock picking performance who is downright pounding the table on Taboola. I'm talking about Barton Crockett of Rosenblatt. He has the kind of impressive track record that makes people stop and listen. As we turn to the Zen Ratings quant model, Taboola also earns an elite A grade, which is given to all stocks in the top 5% of the 4,600 analyzed. In this case, Taboola is actually in the top 1%, which greatly increases the odds of future share price outperformance. As we get down into the component grades, you'll see balance strength in several key areas. Financials in the top 21% of all stocks tracked. Sentiment, the smart money indicator, the top 19%. Growth, top 16%, and top 6% of all stocks for value. This favorable mix suggests we have a healthy, growing company that other investors are sleeping on, leading to seriously attractive value. A pretty good reason why it's in my Zen Investor newsletter portfolio. Before we get to that last stock, one quick thing. If you want to stay one step ahead of the market, then join me live every Monday at 7 p.m. Eastern. That's when I share my updated market outlook and trading plan to outperform. This is also when I unveil my trade of the week based upon our proven Zen Ratings quant model and my greater than 40 years of investing experience. It's a free event, but you do need to register. Just go to WallStreetZen.com/live or click the link in the description below or scan the QR code on your screen. Just pause the video for a moment to sign up. Don't worry, I'll wait for you. And then I look forward to seeing you on Monday. All right, I saved the best for last. That's because I recently gave this stock the high honor of being my stock of the week. And as a side note, the other stocks I talked about today were other recent picks. This company recently did something with its own cash I almost never see from a company this size. Imagine a company spending more than half of its entire market value to buy back its own stock. If that doesn't sound like tremendous management conviction on future growth prospects, then I don't know what does. But let me back it up a little bit to tell you who they are and what they do. The company is called Riskified with the symbol RSKD, and they use AI to guarantee online e-commerce transactions. For example, when you order online, their systems have a split second to decide, is this a real customer or is this fraud? Now, if they get it wrong, then Riskified eats the cost. That's a powerful promise to online retailers and explains why more and more are signing up for the unique services. Now, back to that enormous share buyback program. This is a company with a market cap around $750 million, and yet management has committed $450 million to buying back its own shares. This is a mind-blowing percentage of shares and says that management feels incredibly confident about future growth and what that means for the share price. Now, this doesn't seem like much of a stretch when you consider they have been landing bigger and bigger customers, and this is showing up in their results as proven by their current hot streak of 4 straight earnings beats. And our data backs it up too. Riskified earns an overall A, which again equals a strong buy recommendation. All in all, it ranks in the top 2% of all stocks for its strong fundamental profile in our Zen Ratings model. Now, look at the component grade. 2 grades really jump off the page here. First is growth, which ranks in the top 4% of all stocks tracked. Note this is a measure of the consistency of growth that often portends well for more earnings beats ahead. Likely management agrees with this, which is why they have such a massive buyback program underway. Riskified also scores in the top 4% of all stocks for our AI factor. Now, quick word on that front. It's not about how much AI the company is using. It's our system using AI to spot price patterns that have historically pointed to future share price gains. So, top 4% of this AI timeliness factor points to shares that are likely to outperform the market in the weeks and months ahead. Now, growth plus timeliness, plus massive share price buyback is a good setup for any stock, but especially when leveraging AI for a massive opportunity in online fraud protection. This has me believing these shares could double or more in the year ahead. Another reason it was a welcome addition to my Zen Investor newsletter portfolio. So there you have it, 3 A-rated software companies that are sidestepping the share price problems of their peers and ready for even more upside. Hopefully you can see some of them deserving a spot in your portfolio. Now, quick reminder, the Zen ratings are updated daily, so you can pull a free rating on over 4,600 stocks yourself at WallStreetZen.com. Now I want to hear from you. Which of these 3 stocks do you like the most? And are there any other software names I didn't mention you think are ready to bounce higher? Drop your thoughts in the comment section below for the benefit of our community. And you want to know which stocks I'm keeping my eye on for the next triple-digit AI boom? Then I broke that down in the video that's popping up on your screen right now.